and officially welcome out everyone to the Market Watch Group working sessions. So we're going to hit part 2. So I've gotten some feedback and talked with the powers that be here at the Market Watch Group, and we're looking at diverging the options. And not sure how we're going to do it yet. But when we do the options, we're going to make sure that we maintain a basics where the focus is always and only on buying options. And then we will have a advanced session, a little shorter. And the advanced session is going to be focused on spreads, various spreads. Now, the thought process I'm having is all the spreads are working sessions, and that somebody has access to the recordings to get caught up, rather than trying to just keep cycling through over and over again. I feel like we get the most benefit from the working sessions at that level. So my thought is that, the preface would be, and the prerequisite would be, watch all the videos for the various strategies to make sure you're comfortable, and that they will be ongoing working sessions. And that the beginning sessions will cycle over and over and over, with half of it being education that cycles, half of it being working sessions. That way, we're really trying to cater to the beginning level and the advanced level kind of simultaneously. Give me your thoughts on that. Is that overly ambitious? Is that, so on our Tuesday, Thursdays, if someone's beginner, they'll drop off and they'll be like, yeah, I don't want to go overwhelm myself. And if someone's advanced, they may wait and come later in the day. You can come to all, or you could pick which one you want to do. That's the thought. We're working out the details. I may after we do a working sessions in May, we may go back to an option session again, because we've done 2 passes at the foundations. The recordings are there, right? There's the recordings are there to go through. There's actually 2 different versions, so I might even put them side by side. Like I said, I'm doing some cleanup work on the content library where all those resources are available. So we're going to try to make that easier as well, because at this point now we've got a ton of content that's helps to wrap your mind around the various strategies. Okay, for now though, let's get deeper into the trading plan. First and foremost, as a reminder, we are educational and illustrative purposes only. We are not brokers, we are not advisors. We don't give recommendations, we don't give guidance. Yada, yada, yada. Agenda, trading plan, example. That's what we're getting into today. However, I do want to stop for just 1 second. Let's get the trading plan sample ready. This will be in our resources. You'll have the ability to download a sample trading plan to take a look and say, hey, rather than reinvent the wheel, what would I do to build off of an existing structure? Okay, so if you remember last time we covered, last time I covered section 1, personal information, and to our new person, I'm hoping that you're hearing us. But these trading plans will be available for you to download. The trading plan template will be available for you to download in the MWG Downloads maybe tonight, but at least if not tomorrow. And this is going to be one that is a completed sample. What does it look like when I have a completed trading plan? We did one last week. We did section 2 last week. We talked about the implications primarily of market forecasting. There are videos for these routines of market posturing to help you. Section 3, we talked about what does a full set of rules look like. It's not that much, right? So it's funny because I'm looking at this and this is now 8 pages. So you're like, that's a lot. Well, it is and it isn't. If you spent 1 week with an hour working on just this section here, what am I trying to do? Look at this. I have 2 paragraphs here. One line, couple lines. Now, it's not that easy where it takes me 5 minutes. I'm going to have to think about it. But what it should hopefully show you is that this is a manageable process that to all of us, myself included, at one time or another, felt overwhelming. Everyone says, you need a trading plan. You're like, great, what's that look like? I can tell you, for me, 20 plus years ago, there weren't a lot of good examples. And then I'd find something that would just be like this bullet point outline. I'm like, what is this? This doesn't look like a trading plan. This looks like an outline of like, oh, here's a couple of steps. As I moved forward and thought, if you treat trading like a hobby, it pays you like a hobby. And if you want it to pay you like a business, you need to treat it like a business. That's foundationally the mindset we have to have. And by treat it like a business, I don't mean 50, 60 hours. I mean the commitment that starts with what? A plan. So I took a business plan and said, which of these sections could I, parlay into a trading plan, and which, right? And said, okay, now this is the foundational approach. What we didn't get to last time was risk management. So I did get a big chunk of that. We've already covered routines. We're really going to do this in a separate. We're going to do record keeping and analytics in a separate. And I did touch on some goals. So I have, for what we missed last time, section 6 and 7, that's a separate presentation when we're going to do a record keeping and look at a full 100 trade spreadsheet and say, hey, what when I have this for myself, what do I do with it? How do I learn from it? What does it inform me? Data-driven decisions in our trading, right? We don't just like, oh, let's just keep trading and hope good things eventually happen to us. Everything is on purpose, number one, right? Everything is on purpose that we do. Everything is deliberate. Everything is rehearsed. It's in advance. It's in our plan. We keep records so that we have data to support the decisions and say, yep, this will work. Keep doing it. Or nope, we need to make a change. Okay, so part of that is standardization. That's what we're doing here. We're standardizing our trading plan. Everything we do, our routine, daily, before, during, after, weekly. What do I do on the weekend? We talked about this last time. So let's talk about risk. What are we standardizing with risk? Number one, portfolio heat. That is your total amount of risk across your portfolio. How much heat is your portfolio generating, your risk across the portfolio? So here's a sample. Now remember that portfolio heat is going to directly correlate to Kelly criterion in the record keeping. Right? So here I've said, this is for a profitable system. Here I've said the maximum at any given time is 12. So that's optimum market, optimum risk, 12%. Optimum. Here I've said when conditions are hard to read or the market has high volatility, I'll drop it to 4 to 5%, so less than half. If volatility has settled and trends start redeveloping, so after a drop in the market, I'll increase heat back to 7 or 8. So it'll go to 7 or 8, and then as the market conditions improve, right, our conditions go from a 1 or 2 to a 3 or 4 to a 5 or 6. My risk goes 7 or 8, 9 or 10, 11, 12, and so on. And if I become more profitable, I might eventually get to 15% heat, 18% heat. All of this is adaptive and flexible. That's the first criteria. Now, the second thing we do is we then have to decide, how does that become trade risk? So now we move to the next step, trade risk. 1 to 2% for directional trades. 2 to 3% for delta neutral. Now here's the thing though. Every delta neutral for me is going to start at 1 because I'm willing to put a second and even a third on. I can't start it at 3 and then put a second and then a third, because then I go 3, 6, 9. We have to be thinking about how much risk any given trade has. So I might say, okay, you know what? I'm willing to have a couple of different delta neutral trades. That's up to 6% right there. So right now, if I've dropped my risk a little bit, I might say I'm willing to have a couple of percent bullish, a couple percent bearish. That's 2 of each. And I'm somewhere around 10% risk, with the bulk of it being conservative delta neutral. I'm just giving you an example. Everybody's is going to be very different. This is just trying to get you to think about what are your conditions, right? What are we doing here? You'll notice under portfolio heat, what else did I say? I said I'm going to reevaluate my heat every 100 trades according to Kelly criteria. Every 100 trades, I'll have a spreadsheet, and that spreadsheet will tell me something. Hopefully it tells me that I have a positive expectancy, which means I'm profitable. And it will tell me that, hey, look, you can take X amount of risk, more, less, whatever it is. Okay, great. So that's how I make the adjustment. Trade risk. Well, you can see that we can actually take, if I decide I'm going to do less trades, I can take more risk per trade. My preference is the 1%, 1% per trade in order to get more trades on. Now, the last thing we have to think about is how many total trades then. So we have to make sure that all of these 3 pillars of our risk management considerations check and balance. I can't say my portfolio heats 10% and now I have 15 trades with 2% risk per trade. 15 times 2 is 30. What are you talking about? You're way above. Whatever way you go, some people start at number of trades. I know people who say, I'm not comfortable with more than 5 trades. Oh, okay, 5 trades it is. And they say, I'm not comfortable taking more than 10% risk. 5 trades, 10% risk, 2% per trade. Bam, they found it. Some people I like to start at portfolio heat. It doesn't matter where you start. They just, all 3 have to connect. If they don't, well, then there's a disconnect. You found a hole in your trading plan that you need to work on, and you need to connect those dots. So portfolio heat, trade risk, number of trades. Remember also that we might have different levels of trade risk for different systems. We might say, you might actually have where you're like, hey, I'm going to be 20. Now, if this is your trading capital, you might say, I'm willing to have 20 to 30% of my trading capital at risk over 3 different systems and have that defined. Whatever it is, define it. Define it. Write it. Flesh it out. Think about it. Risk adjustments. You can see here that adjustments will be made as portfolio heat expands or contracts according to the heat parameters above. What is the correlation to current market posture? I actually kind of defined that already, but I can put a little bit more information here. You can see we're just trying to make sure that we've got that connection. You don't just have risk and define it and leave it. That's very static. This is a very dynamic risk management plan. Better market, be more aggressive. Imagine if you're a pretty good poker player. Yeah? Pretty good poker player, and you find yourself at a garage game in a real nice neighborhood. Those are good conditions. You got some regular Joes with money at a garage. Yeah, you'll probably play pretty aggressively. And then all of a sudden, you find yourself at the $20 limit or $20 minimum poker table at the Bellagio. And there's some professionals at this table. Well, you're going to be a lot more careful in that table, right? You're recognizing that context matters as to how you conduct yourself, how much risk you take, how aggressively you play. It's the same thing that we're doing here. We're basically saying, what's the context? What are we doing here? What makes us take more risk? What makes us take less or redistribute it to other strategies? But whatever it is, define it. Think to yourself, this is the best market I've ever seen. Great. What would your risk look like? Think to yourself, this is the worst market I've ever seen. It's down. It's this. Great. What are you doing? What does it look like? We're chess players. We're thinking 4 or 5 moves ahead. The more of these scenarios you predefine, the easier it is for you to know how and when to make your adjustments. Your risk should not. This is one of the biggest and most common mistakes I see in trading, is that people just do the same thing all the time, as if there's just this A plus B equals I make money formula, and all you got to do is adhere to it. There is a formula. It's a lot more complex than A plus B equals I make money. You'll find it here in this 8-page, not quite finished sample trading plan, right? Where all of our routines are outlined, all of our rules are defined. And you start to realize that we have expectations of success. We have expectancy for our record keeping. That's it. Okay, so what's next? We correlate it to the market posture. Tsunami indicators. Here's mine. I've talked about this. Obviously, high or low on the VIX. That is my absolute number one. That is the big one for me that generates most of my hedging. High or low on the VIX. Expansion, escalation, whatever you want to call it. That is always something that has me cautious. And I actually trade similarly to the other side when I see de-escalation or a lower high. I'm looking for defensive rotation in our major market analysis. If I see the Dow rotating to the top, and at the same time, especially the NASDAQ and the Russell rotating to the bottom, that's absolutely something that I'd be like, I want to make sure I'm protected. I want to make sure that I'm, dug in. This is a foxhole market now. Dig in. Be careful. Get that risk down to that 4 to 5% level and protect yourself. I'm watching for defensive shifts in our sector rotation, which we've seen a little of, right? The utilities shooting to the top. Staples not as much, and we still have other things that are holding strength. So we're not quite to a certain point yet, but we've certainly seen enough that we're concerned. So what are your tsunami indicators? You might watch the dollar. We watch the U.S. dollar. You might watch bonds. You might watch... There's a number of things that people will swear by. Oh, when this happens. Okay. Find one that you like. And keep an eye on it. Go back in time, though. Test it. Go back in time and look at periods when the market did get nasty. How did that signal do? Now, I don't mind if it gives false signals. You've seen that I've gotten false signals on the VIX. Of course it does sometimes. That's how hedging works. But make sure that over time it holds water as a hedge signal. Last and certainly not least, taking a break. If you watch, you see I haven't watched it for a long time. I used to play a lot of poker and I used to watch it more. I love it for poker. I love it for trading analogies because there's a lot of similarities. But if you ever watch like the World Series of Poker, you'll see guys just get up, walk away from the table for a little bit, just take a break, even when hands are going. You might blind out a couple of times a little bit, but for the most part, you're just kind of, sometimes you got to just take a little break. Same thing with trading, where you just stop for a little bit. When and why? Number one, if you potentially draw down too much. So some people might say, you know what, if I draw down 10%, 15%. Remember, if I draw down 10, I have to make 11 to get it back. If I draw down 15, I have to make 20. I believe that's right. Yeah. Those are recoverable. It gets worse from there, right? Draw down 20, got to make 25. Draw down 40, got to make 66. Draw down 50, got to make 100, and so on. The more you lose, the harder it is to recover. Don't lose. At least don't lose much. So if you have a drawdown, if you have a certain number of trades, if I have 5 trades in a row, don't make it 2 or 3, please. Please. No less than 4. Where you stop and you evaluate those last 4 trades and say, hey, I had 4 losers in a row. Am I reading the market wrong? Let's look at those 4. Let's look at my market posture. Am I missing something? Right? Was I on the fence? Did I overinflate? Is this me? That's the first thing. That's the very first thing about taking a break. Get your mirror out. Did I do this? Is this my fault? Most of the time it is. So be ready. But right, that's the first thing is, or people are like, well, maybe the market shifted. Well, if the market shifted, whose job is it to see that? Are you expecting the market to write you a letter and or an email? Or are you supposed to see it and make those adjustments? So it comes back to you and you go to your market posture and you say, what did I miss? And then learn from it so you don't miss that again. That's what I mean when I say this structure in our trading is what allows for us to have a continuous improvement mindset. Kaizen, always getting better. So if there's a certain number of losing trades in a row, the last one, and this is actually the one that I end up succumbing to most frequently over the last decade, where I'm just simply out of my trading flow. In poker, they call it on tilt. He's on tilt. Which means what? He's pushing, he's emotional, he's impatient, he's frustrated, or she, Sandy, or she. Right? So, recognizing, hey, you know what? I'm pushing. I'm impatient here. I'm gonna take 3 to 5 days, step back. I'm gonna keep watching the market, keep watching my watch list, but I'm not gonna trade. I'm just gonna watch it. Funny thing is, I'll always tell myself, take a week, and then by the end of day 3, I have a trade that I want to take, and I'll say, you know what? I feel okay. I'm gonna go ahead and take it. The reset, always good. Always like it. So think about that. Do you ever need to take a break? And then when you take a break, it's not like walk away and do nothing. It's like just take a step back and remove yourself from the risk cycle. When you know you're not going to pull the trigger for a little bit, it allows you to just sort of kind of decompress a little and evaluate what's been going on. Be reflective in that time. Okay, so questions about anything in risk management. This is the deep dive. Remember, there's a video, but it's not as deep as this. So now is your time. Do you have any questions about any part? Portfolio heat, trade risk, number of trades, how you make risk adjustments, how you correlate your risk to current market posture. What are your tsunami indicators that say, hey, what do I mean by that? Well, if you missed the analogy, I mean, what's going on that the water leaves the beach and it's calm for a little while. Then it comes back with a ferocity. And that's what happens in the market. There's often the calm before the storm where you're like, so let's make sure that we see those things for what they are. And then lastly, the taking a break. Good review. Awesome. Okay, good. So like I said, we've already talked about routines. I hope you're feeling good about your routines. What, when, for how long, then what are we doing, and in what order? That's what we've got here for daily, weekly, monthly routines and record keeping, right? We know we have our 2 trade logs, whether it's stocks or options. Analytics. The analytics is, Scott, are we going to dive into where we set some sort of, well, Stephen, that's a good question. I feel like we just dove into that. You tell me what you mean by dive into that. We were just talking about risk on the portfolio level, correlating that to your portfolio heat, which means it's going to tend to be around like 10 to 15%. Risk per trade, 1 to 2. If you're doing delta neutral, it might be a little higher. Is that what you mean when you say risk parameters? Or what risk parameters? You type that in. I'm going to keep moving forward because I feel like, that's, as far as those individual numbers, those are all very personal numbers that every trader kind of works their way towards. If a stock is at $20, so now that's not a risk management. That's a trading rule, right? If a stock is at $20, let's scroll up a little bit. And you can see here under my trading systems, every system is going to have entries followed by stops. So for example, I initially look 0.5% below the lowest point of a recent support level. I sometimes will look at the lowest point of a Heikin-Ashi candle, right? There's various things you can look at where you're saying, where was the last point that the sellers failed to push it down and the buyers came in? That's the point that I want to give it a chance to bounce off of again, potentially, but not let it break through. So what you're talking about certainly has a influence in our risk control, but that would be a trading rule that combined with our risk management rule is how we would establish position size based on trade risk and risk per trade. So, great question. And like I said, look how the trading plan answers these questions. Just sort of exists for it's a representation of you. This is a dynamic thing. This is getting good. I hope you like where this trading plan is going. Let me scroll back down. It's getting hard to find our way through this beast. Okay. Section 8, improvement strategies. Okay. Number 1, outcome goals. What do I mean by that? I want to make 20% this year. I want to make 2% per month. I want to make. It tends to be like, what do I hope for? That's an outcome goal. I would prefer to see you making projections that based on X expectancy with your account size and your risk per trade and the number of trades that you average in any given period, you would expect to make 34% per year because of that. If that's where you are with your trading business, You are there. You have achieved it. So I want to see you focus on process goals, improving the trading process, because if we focus our attention on trading well, the results will take care of themselves. So I have two examples of process goals here. Although I would need to translate this one. This is really more of a analytic goal that I turn into a process goal. Reduce my average loss size by 10%. Yeah, I actually mischaracterized that. I would actually bring that down here. Let's bring that down here. This is why I love an outline for a trading plan. It's very easy for us to make adjustments. Okay. Now, a process goal. I want to improve my daily execution score from a 6.5 to over 8. And you're like, what are you talking about? So one of the things that I've done before is I've established I've taken my daily routines of all the things that I want to do, how I want to manage my trades, the prioritization, and I would say, all right, and put it all together and make a 10-point score. So if I did this, if I did that, and knock off, and I'd basically say, all right, I want to have at least an 8 or higher, over an 8. Little mechanisms of accountability that help me to say, am I as consistent as I want to be in executing these routines? So that's a process goal. I'm trying to improve how effectively I execute my daily routine, my morning, afternoon, evening, and adhere to my rules on a daily basis. That's an example of a process goal. So anything where you're like, I want to do something in my trading plan better, and you set a goal around it. Now, of course, we want to use SMART goals: specific, measurable, achievable, timeline, action steps, monitor frequency. Did you achieve it? Do you set it again, etc.? But as far as goals go, we want process goals. Well, I want goals that focus on weaknesses and trading priorities. So here at this part, I can now go back up to section 1. And if I put some real thought into it, I can say, all right, what are my weaknesses? I tend to be influenced by preferential bias. What does that mean? It means that when I'm bullish, I stay bullish sometimes longer than I should in a trade. Now, not always. Some of these are from previous, right? I've already worked on. Or, right, if my analysis, we tend to lean a certain way. And in preferential bias, we search confirmation bias, which is we go find information like, oh, look at this. You'll ignore 2 negative news articles and find a positive one and say, oh, look. Right? So that's a weakness that I've had, that I've worked on. A very similar market weakness that led to the market posture process we all use. I tend to sometimes rush. I rush to judgment. I'm fast to trade, and then I'm like, ooh, forgot to look at that. So I sometimes suffer from outcome bias, letting thoughts wander to the end of a trade, and I lose focus in real time. Those are weaknesses. Now, I take those and I come back down here and I set a goal, and I say, I want to conduct a daily preferential bias check. What does that look like? It's basically acknowledging that I tend to have a preference, so I'm going to stop, look at my outcome, look at my market posture, look what the market's doing, look what my trades are doing, and then ask myself, Am I objective in how I'm seeing this? Do I know that that's going to help? No, but I'm trying to do something to where eventually I want to be able to say, you know what? I don't have that preferential. I'm not doing that anymore. Right? I don't do that anymore. I now am objective enough because I've forced myself to develop a habit of that. So what does this look like? Well, it depends on the person. You'll notice here's another one. Make sure to do a discount double check on every trade until I have 10 in a row without a hasty judgment. Which means that if I'm about to pull the trigger, I'm going to stop and I'm going to go back and I'm just going to one more time check everything. Right? I'm about to jump out of a plane. I'm going to check my parachute real quick. Is everything secure? Everything's on? Ready to go? Okay. Now, if I get to a point where I'm 6 trades in, then I find myself like, I rushed again. Boom. It resets. I have a goal. 10 in a row without a hasty judgment. When I get to 10, I can complete that goal. And then I'll go into my weakness section and I'll find something new. And it's just ongoing. When we do improvements in trading, we're not trying to vastly change our trading systems all the time. It's like, look, you probably have a great starting point. You're just trying to tweak it a little bit, trying to be more consistent, trying to get out of your own way a little bit more. Patience to follow my trading rules or not improving the rules when needed. I love that. If it ain't broke, don't fix it. I have people who think, like I said, trade goes wrong, two in a row, and they're like, oh, it's broken. I'm like, after 2 trades, it's broken? How did you ever think it was working in the first place? If 2 trades shakes you from that. I love that. Thank you for that comment. Okay, so that would be a couple of weaknesses. How do we take weaknesses? And you'll notice here, what we're trying to do is just create accountability measures. You'll add these things to your daily routine. I'm going to do my discount double check. I know I love that. What is that? Insurance company. I like the commercial, but I forget. Progressive? No. Anyways. Next, setting goals based on analytics. Reduce average loss by 10%. To some extent, it's an outcome, but it's not our outcome, meaning profit or not. It's saying, hey, I'm going to really focus on my average losses, and I'm going to try to reduce it by 10%. How? That's the question. How? How are you going to do that? Because if after another series of 25 trades, your average loss has gotten worse, then whatever you thought you were going to do didn't work and you need to change it. But at least if you start with something, you can really start to dial it in and find yourself making progress. I put an asterisk next to that because at any given time, I'm trying to reduce my average loss by 10%, right? Sometimes I hit it, sometimes I don't, but I'm always trying. Let your winners run. So for this, I might keep my eye on my average length in trade for winning trades to help validate new rules that I have to see if I maximize win. If I think, hey, you know what? Winning trades should be 7 days instead. Great. Unless I make it to 7 days and my average loss has shrunk even more. Then I'd be like, wait a second. Maybe instead of 5 days to 7, I needed 5 to go to 4. Maybe I'm letting them run too long. But what you'll notice is we're very, very purposeful in trying to figure out what can I do to lose less when I'm wrong? What can I do to make more when I'm right? When we start to prime our mindset for that, we look for patterns, we look for ways, and it just sets us on a path to find that improvement. Okay, so that are your trading goals. Remember, you want a goal setting process. You want to have like a spreadsheet where you keep your goals and you make notes and you open and you close them and you put your next one so you can go back and be like, hey, I tried this goal a couple years ago. What happened? You might have some notes where things went wrong or what, right? You're experimenting. This is the scientific method here. So take good notes, write it down. You might come back to it. And don't forget that successful traders do what failing traders don't want to. Traders want to sit down and slap it on. I'm trading, yeah. And then they go to their yacht and sip their cocktail. That's not trading. Not really. Questions? I'm gonna try to finish this with some notes in other areas, polish it up a little bit. My bullets got a little unwieldy, and then I'm gonna save it, and then I'm gonna post it, a downloadable version. I'm gonna post a downloadable version so you can grab this. We'll call this sample trading plan outline, and I hope that provides some inspiration, some ideas. I hope it allows you to see that in 1 hour, a week, we can easily put a good amount of work into every one of these sections. So, thank you, Sandy. I appreciate that. Bob seconds that motion. What do you guys think about the market today? Stephen Third. Yes, love it. Thank you, guys. Let's bring this over. Let's just talk about the market for 1 second before we wrap it up, because, we're the Market Watch group. We got to watch the market. Okay. What do we have going on here? Let's move you down. Let's move you down. Let's move you down. I gotta say, for me, we started higher. We moved a little bit up. We couldn't hold on. We finished up 0.11%. The volume is just paltry these last 2 days. So, pardon me. I feel like what we're seeing here is very similar to what's going on right over here, right? It goes up, pulls back, and then up again. We went up, we pulled back, up again. And you can see the same thing. Look at that. It went up on this low volume. Right through here. We're going up on this low volume. Yeah, I'm a little bit worried about this double dip and even second, triple dip. So over here, let's see. I'm going to move this. So this one was not as big, you can see. And then let's duplicate this one. But from this point here, it was a little worse even still. So if we do the same thing here, and then we say a little worse even still, you can see where that puts us. That's to this next line here. And if we rally up and drop again, that could be the full 10% down near 470. Yeah, I'm concerned. I'm concerned about this. Here's the VIX. The VIX looks actually quite good. Quite good. It's very low. So if you are bullish and you need some hedges, they're there. Neutral trades, I would say calendar spread. But it feels a little calm before the storm, if you ask me. Same thing happened back here. If you look, this was right before that big drop in September. It was at new lows. Everything looked good and rosy, and then bammo. So be careful. Be careful. Anything else before we wrap it up? Did I miss anything? Butterfly starved today. That's all right. Great market portfolio growing. Love it. All right. Well, listen. It's good to see you guys. New person. Loved having you. Would love to have you participate. Feel comfortable not participating. It's up to you. But we'll have some fun in here. Tomorrow morning, weekly market. We'll have our midweek check-in. Take a look. Do we start getting a little more concerned? Do things start to roll over, etc.? It's great to see you guys. Have a great rest of your night. Stephen will not be on tomorrow morning. Stephen, travel safely. You'll be in the air. Got it. Stephen, I hope you travel safely. All right. Yeah. Thank you, guys. Have a great rest of your night. And as always, happy trading.